Okay, good morning, guys. Welcome to today's class. So today we're going to cover a revenue question. It's one of the revenue questions in the CTA. I think it's in Fact 1 and Fact 2, or I mean Fact 3, not Fact 2 and Fact 4. So it's in both Fact 2 and Fact 4. It is a past ITC question paper, or ITC question that UNISA slightly modified. So this question was probably one of the first revenue questions that was tested in detail by SAICA. So when a new standard comes out, it may form part of the syllabus, but in the first year or first 2 years, SAICA tested very minimally. Then after the second or third, either in the second year or the third year, once the standard has been taught well at universities, then SAICA tested in depth. Okay, that has generally been the trend. When a new standard comes out, in the first year or two, SAICA tested very minimally, but then in the second or the third year, definitely from the third year onwards, then SAICA tested in depth. So this question is a big question. It tests revenue thoroughly. So it doesn't test everything of revenue, but it tests all the important stuff that at the university level that is important. In the real world, there's a lot more that's important, but for our purposes, this covers every important aspect that you need to know for revenue. But obviously don't limit yourself to it, because they can test other stuff. But this one question that tests various aspects in quite some detail. So the way we're going to go about this is I'll just spend about 10-15 minutes giving you a high-level overview of revenue, just a five-step process. Obviously, there's much more to the five-step process, but then we will cover those details as we go through the question. Because the question is quite detailed, so I don't want to go through the whole revenue standard, because we're going to sit here for a whole day. So I'm going to cover the revenue standard as we go through the question. But just to start off, I'll give you a feel of the revenue standard using the five-step process or the five-step model. So we do know that we have a new standard on revenue. Well, not so much anymore so new, because it's been out now for about 3 years or so. I think it came out in 2017, I think. So with the revenue, so the new revenue standard is IFRS 15. So what we know, before IFRS 15, the main revenue standard was IAS 18, but then there was many other accompanying standards to complement IAS 18. So IAS 18 was the main revenue standard. Then the second main one was IAS 11, which dealt with construction contracts. And then there was other supplementary detail. Also important part of the standard, like for example, what we call it now, explanation guidance, like the IFRS or the, I can't remember what's the IAS one's called, but basically it had, I think revenue had about 5 or 6 or 7 standards in total that you needed to learn. So because that was quite messy, that is why the ISB decided to create a new revenue standard that is basically all-encompassing, and that it's more principle-based and all-encompassing. So they try to kill two birds with one stone. Number one, to eliminate all the other revenue standards and just have one revenue standard that is applicable to basically every revenue transaction. That's why it's principle-based. And then number two, although it's called IFRS, International Financial Reporting Standards, most countries in the world use IFRS, but one of the biggest economies in the world do not use IFRS, and that is the USA. So the USA has their own US GAAP. So part of the project that the ISB wanted is where the ISB, the International Accounting Standards Board, and the US, whatever they are called, can't remember what they are called, where they have a convergence project where they have one set of standards. That didn't really work out. So obviously you understand that the US have their way of thinking, and the rest of the world have their way of thinking. So most countries in the world use IFRS, besides USA, which is obviously a big component. So that was like kind of the two parts to it. So they have one revenue standard that eliminates all the other revenue standards, but also this one revenue standard must also be where the ISB as well as the US GAAP have basically the same thing. I don't think it exactly worked out. They had a few projects like that. I don't think it turned out that great. But anyway, that is basically like part of the reasoning of the changes in standard. Obviously, they needed, yeah, so that is basically it. So with IFRS 15, they came up with a 5-step model, right? So for every contract, so what you must understand the term, the name of the standard, IFRS 15, contracts with customers. Okay, so it is contracts with customers. So there's two parts to that name. One, there's a contract. Number two, it is with customers. So what is a customer? A customer is someone who buys from you or who you sell to in the ordinary course of your business. So for example, Pick n Pay, what would be their customer? You and I that buys groceries from them. But if Pick n Pay sell their office building, or if Pick n Pay sell the CEO's vehicle, that is not a contract with a customer, because the person buying the vehicle or the person buying the building is not a customer, because they're not transacting with Pick n Pay in the ordinary course of business. So what is a customer? Someone that transacts with you in the ordinary course of business. Okay, there may be some how can I say, exceptions, but that is an important thing to understand. Okay, and then you must have a contract. So in the 5-step model, what are the 5 steps? Number 1, you have a contract with a customer. Number 2, you must identify performance obligations. This is extremely important. Step number 2. Step number 3, determine the transaction price. Step number 4, allocate the transaction price. And step number 5, recognize revenue. So step number 1 is not simple. In reality, it's not simple, but it's fairly simple for our purposes. Okay, I mean, I can ask you a 20-mark question on discussing or determining a contract with a customer, but for our purpose, I don't think that is really relevant. But it can. I mean, that's how detailed contracts with customers are. It can be that detailed, right? But generally, a contract with a customer is it can be written, it can be verbal, it can be just normal practice. So for example, you and I, when we shop at Pick n Pay or Checkers, we don't have a formal written contract. It's just through business practice that the transaction between, when we buy something from Pick n Pay, and the transaction between us and Pick n Pay, through normal business practice, that is considered to be a contract. The moment we go to the till and they swipe, they scan the thing, and you pay for the money and they give us and we walk off with the groceries, that whole thing is considered a contract. Okay, so it is just normal business practice. They don't have to be a formal agreement. Similarly, or likewise, when you take out a cell phone contract, there will be a formal agreement. But that's how the business practice works, that you have to sign a contract. Or when you buy a vehicle or you buy a house, there are certain things that they are physical contracts that you're entering into. But like I said, when you go to the normal store, you're not entering into a physical contract, but just a normal business practice. That transaction between us and the store, that is considered to be a contract. So just take a note of that. Now, step number 1, like I said, it can be very detailed. In reality, it is detailed. Like I remember, when I worked at one of the financial services companies, like a big one, 3 years before IFRS 15 came into play, they already contracted with one of the big 4 auditing firms, because they had to go through a process of working through the contracts. They went through a process of putting into place how they recognize, they started 3 years before the time to implement IFRS 15, so that when IFRS 15 becomes mandatory, they are ready to hit the ball rolling. So all the big companies did that. The smaller companies didn't care because it's not such a big exercise, but for the bigger companies, it was a huge exercise. The same thing with IFRS 9, they did the same thing 3 years before the time. They started going through IFRS 9 items. So one of the important aspects with financial services, if you read all your contracts carefully, there's more than one item in a contract. So they needed to work through those, and they make sure that with the current, before IFRS 15, that one contract could be recognized as the revenue as one item. But IFRS 15 didn't allow that. They needed to go through the contract and identify each performance obligation within the contract, and then determine whether they have to recognize revenue separately as separate performance obligations, or whether the contract as is okay. So that was a lengthy process, given the different types of products the financial services companies have. So that is why in reality, contracts with customers is not simple, but for our purposes, it is generally simple. But you do want to go into detail with it, because they can ask a question on the ongoing understanding contracts and identifying the various aspects. Okay, but like I said, usually it's not a big thing. Step 2 to step 5, that is where the meat lies from an academic, from our point of view. Okay, in reality, step 1 to step 5 is important. For our purposes, generally step 2 to step 5. I want to make it clear, I'm not saying step 1 is not important. You must go through step 1, but first focus on step 2 to step 5, then you look at step 1 to make sure you enhance your understanding, so that when you do come across a question that tests step 1 in detail, you are able to handle it. So step 2 is extremely important. Okay, step 2 filters through. So remember, step 1 will help you to identify step 2, but basically step 2 is extremely important. Step 2 is that you need to identify separate performance obligations. Now, I'm going to use a cell phone example, and the reason why I'm going to use a cell phone example, for 2 reasons. Number one, when IFRS 15 came out, the first industry that everybody knew was going to be impacted was the cell phone industry. Not cell phone industry, like Cell C, MTN, Vodacom, those cell phone contracts. Okay, what you call it, mobile operators. And then the second reason I'm also using cell phones is because the question is about cell phones. And it's not a surprise that question is about cell phones, because that was kind of one of the first detailed questions set by SAICA, and everybody knew that one of the biggest impacts of IFRS 15 will be on the cell phone operators. And that is why it was so easy to create a question regarding that. Okay, because there was a lot of talk about it. So it was much easier. So the 2 reasons is, number one, IFRS 15 was very applicable to cell phone operators, and then number 2 is also we're also dealing with cell phones in this question set by by the SAICA exam. Now, with the performance obligation, you need to identify separate performance obligations. So just think about it: when you enter into a cell phone contract, what is usually part of a cell phone contract? The phone, and then you get the other parts. So the other parts is usually data. It is a SIM card. It is voice minutes. It is SMS minutes. So that is generally what you get: data, voice minutes, and SMSs, a SIM card, and then a cell phone. So there's basically 5 things over there. Okay. So the question is, are those 5 things separate performance obligations? Are they one performance obligations? Or is the cell phone one performance obligation and then everything else a second performance obligation? Or is the cell phone one performance obligation, the voice minutes a separate performance obligation, the data minutes a separate performance obligation, the SMS is a separate performance obligation, and so forth? Or is the whole package one performance obligation? So that is the question. So how do you answer it? IFRS 15, I think IFRS 15 paragraph 22, I think it's paragraph 22, tells you how to identify a separate performance obligation. In order for there to be a separate performance obligations, you need to determine whether the goods are distinct. Okay, so IFRS 15 tells you that in order for an item to be a separate performance obligation, although the terminology that IFRS 15 uses, and this is what you want to use when you write a discussion, is you don't use the word item. You want to use the term or words promised goods or services. So when you want to refer to the item, so for example, when you want to refer to the voice minutes, you say the promised goods or services. That is the terminology that IFRS 15 used. So I said, in order to identify the separate performance obligations for each item, you want to replace the word item by promised goods or services. So, I lost my train of thought now. Yeah, so in order for each promised goods or services to be a separate performance obligation, the promised goods or services needs to be distinct. So that is a terminology you want to use when you write a discussion, the word distinct. Now, in order for a promised goods or service to be distinct, what do you, it needs to meet two sets of criteria. Okay, so it needs to meet two sets of criteria. Now I'll show you the two sets of criteria on the Edion's website. I was going to get to the Edion's website quickly. Okay, so while Edion's website loads, let's just go on so long. So remember, you want to identify, so step number 2, identify separate performance obligations. In order to identify separate performance obligations, the promised goods or services within the contract needs to be distinct. In order for these promised goods or services within the contract to be distinct, it needs to meet two criteria, and it must meet both. In some instances, it will meet none. In some instances, so if it meets none, it is not a separate performance obligation. In another instance, it will meet both. It has to meet both for it to be a separate performance obligation. So if it does meet both, it is a separate performance obligation. And in other instances, it will meet one of the two. If it meets one of the two, it's not a separate performance obligation. It must meet both criteria. Okay, so that is your separate performance obligations. Now that you have identified your separate performance obligations, the next step, step number 3, is to determine the transaction price. The transaction price is generally straightforward in that you just want to work at a total transaction price. So for example, the total transaction price, if you take out a contract, it is, let's say, a 24-month contract at 200 Rand per month. So let's make it simple, 1,000 Rand per month. So you have a contract of 1,000 Rand per month for 24 months. So the transaction price is 1,000 times 24 months, which is 24,000 Rand. Okay, that is generally as simple as it gets for the transaction price. Now that you have step number 2, you have identified the separate performance obligations. You have step number 3, you determined the transaction price. Now comes step number 4. Now step number 2 and step number 4 are generally the very challenging ones. So step number 4 is now to allocate the transaction price. Okay, step number 4 is to allocate the transaction price. So that 24,000 Rand must be allocated to the different performance obligations. So if you identify 2 performance obligations in step number 2, the transaction price you will allocate to 2 separate performance obligations. If you identified 1 performance obligation, then that full 24,000 Rand will be allocated to the 1 performance obligation. If you identified 5 separate performance obligations in step number 2, then you will allocate the transaction price to the 4 or whatever 5 separate performance obligations. So the question now is, how do you allocate to the separate performance obligations? So the rule is, or the principle is, that you allocate a transaction price. You allocate the transaction price to the separate performance obligations based on a relative standalone selling price. So for example, the contract is 1,000 Rand per month, and that 1,000 Rand, so we got for 24 months, we got 24,000 Rand. Let's just for explanation purposes, let's just assume that there are two performance obligations, the cell phone and then everything else, the minutes, the data, the SMSs, okay? So let's just assume there's two separate performance obligations. So standalone selling prices means if I go into the store and I only buy the cell phone, how much would I pay? If I go into the store and I only enter into a contract for the data, minutes, and what did I say? Data, minutes, SMSs, how much would I pay? So that is relative standalone selling prices. So we will use that and allocate. Okay, so we will show you how to do that. Now that you have identified, step number 2, you have identified the separate performance obligations. Step number 3, you have determined the transaction price. And step number 4, you have allocated the transaction price to the separate performance obligations. Now comes step number 5, and that is to recognize revenue. In order to recognize revenue, there's one of two options only. You only recognize revenue at a point in time, or you recognize revenue over a period of time. Okay, so you recognize revenue at a point in